A few days ago, I did a video about signs that the housing market is crashing. And a lot of people made comments on it, and it seemed like a lot of people enjoyed the video. But a lot of people were getting confused when I was talking, well, some people, about, I was talking about the housing market crash, but there are signs about the economy crashing too, or going into a recession or a deep recession. So what I did is I did some research. Full disclosure, I'm not an economist. I'm not, I'm the person just like you guys, I just do my research and I find really interesting articles, and then basically I talk about it. So we're going to go over signs that the economy is in trouble. And some of the signs might be here, some of them may not be here, but let's talk about them, because like I was telling everybody before in that video, things don't seem like right now. They don't seem, people aren't comfortable with everything that's going on. And so let's go over some economic signs. In the meantime, if you guys like this kind of video, do me a favor, subscribe. It takes less than a second. It's greatly appreciated, and it really helps out this channel. All right, let's get started. And let's keep in mind, a downturn in the economy doesn't happen all at once. It's not like an overnight thing. It's a slow progression. So basically, like the Feds, they paused interest rates. They didn't raise interest rates this month. But what they did 3 months ago, 6 months ago, 7 months ago is now catching up. There's a lag time to everything. So it's not like we're going to wake up and tomorrow we're going to be in a recession. I mean, some people are saying we're already in a recession, but it's a gradual thing. So what we have to do is we have to look at the signs of a pending recession, or worse, because we haven't had a really big downturn in the economy since the pandemic. So let's get started. The first thing is climbing unemployment rate. Man, it's windy. So the rate, I think, for unemployment was 3.8% in September. So it's not bad, but a lot of people are saying that there's more and more people getting laid off, and we just haven't seen the numbers yet, but people are saying that they might be losing their jobs. So back in, I wrote down some numbers. We peaked in December of 2009, okay, during the great crash, real estate crash and everything. Unemployment reached 9.9%, okay? And in April of 2020, at pandemic time, when everybody was forced to leave their jobs, it went all the way up to 14.7%. So if you start seeing an uptick in unemployment, that's an indication we're in trouble. Let's go on to number 2, the stock market. So basically, if the stock market is going crazy and it's declining, that's an indication, because a lot of those people, those companies, they put research into it and they're like, all right, we're not comfortable with what's going on. And a lot of people, they get out of their stocks and, they put, maybe they're holding on to cash, they're not investing as much. Maybe they're buying treasury bills, things like that. So if you're seeing the stock market, become volatile, like this year, like it doesn't seem like it's doing that great lately, but that's a big indication too. So watch the stock market. And all this information that I'm telling you guys now, I got it from an article, the 11 signs the economy could be in trouble. And I'll post the original article below so you guys could read it also and put your own opinion in there. So if you like these kind of articles, do me a favor, comment below. So let's get started. Let's go on to number 3. So number 2 is the stock market, if the stock market is going down. Number 3 is consumer confidence. And I mentioned number 3 in the video I did on signs of the housing crash, because If people aren't feeling good about the economy, they're not spending money. If they're not spending money, factories and stores aren't selling product, and that's a big sign. So look at the consumer confidence rate and see what that says. Because if a consumer confidence is declining, that's an indication we're in trouble. That means people are tightening up their belts and they're afraid of spending money, you know? Especially in these interest environments right now. Like, to buy a new car, even with excellent credit, you're still looking at 7.5% to 8.5%. And people with not so good credit are paying 14, 15%. So, and a lot of people, you know, I said this too in the previous video, a lot of people are losing their vehicles. They're getting repoed. So consumer confidence is number 3. And I talk to a lot of people because, you know, I do inspections and stuff. And I'm telling you, I haven't talked to anybody in months that are telling me things are great. They couldn't be perfect. You know, I'm fine. I'm comfortable buying this house or this car or going on this trip. I'm confident in the future. At least I haven't found it. I'm sure there's people out there that are confident in the economy and think everything's great, but at least I'm not running into them. Tell me what you guys are confident? How's your consumer confidence? Do you think things are going good? Do me a favor, mention below, comment below, and I'll reply to all of them. It's greatly appreciated if you do, so I can see what the feedback is from you guys out there. Let's go on to number 4. Number 4, inverted yield curve. And I'm going to read this right from the article so everybody knows what it is. Traditionally, long-term bonds yield higher returns than short-term ones. But when investors expect a recession, they might choose to invest in long-term bonds, causing the yield to drop below the short-term bonds. This inversion can be an indication of an impending economic decline. So if there's an inverted yield curve, people are saying that's a bad sign, and it's usually an indication that we're heading towards a recession. Do I know a lot about that? No, I've been watching some videos about it, and it makes sense, and a lot of people show graphs, and every time there was a recession, right before it, there was an inverted yield curve. So, you know, I would check that one out and do some research on your own, and tell me what you guys think about this inverted yield curve. All right, let's go on to the next one. I believe it's number 5. Decrease in gross domestic product, GDP. So basically, the GDP, it actually grew a little bit. So if you see the gross domestic product declining and we don't meet the numbers that we expect and it's going down, that means we're heading towards a recession. I think that's one of the biggest indicators is GDP. So the last one was higher than we expected, which I guess is a good thing, but it seems like every time they say, okay, this is what the GDP is for this month, the following month, when nobody's looking, they revise it a little bit. So the revisions come in and they don't make a big deal about it. They make a big deal about the GDP when it first comes out, especially if it's good, because it's good for the politics. But then there's revisions, and in the revisions, they lower it, and nobody really talks about that. So that's another indication. Follow it, and follow the revisions that they do with them too. All right, let's go on to the next one. All right, number 5, national debt. So basically, we know that the government pretty much spends money like it's nothing. And if they need money, they'll print more of it. Hopefully those days are over with, but they spent crazy amounts of money. So if the national debt increases to the point that we don't bring in enough money to cover the national debt, so basically we're paying so much in interest every day, especially with these interest rates. So follow the national debt, according to this article. If the national debt is increasing dramatically, they're going to have to do something. They're going to have to raise taxes, or they're going to have to print more money. And then if they print more money, it devaluates the dollar. And then if they stimulate the economy, you know, with bucks, then inflation, you know, we could start having inflation again. Not that we don't have inflation now, trust me. When you go to the supermarket, you're reminded of inflation every day, or you're going to go buy something, you're reminded of inflation. So think about that one, national debt. Pay attention to it. And if the national debt is increasing, that's a sign. All right, let's go on to number 6. All right, the next one is decrease housing activity. Like, we all know that the housing activity is decreasing in some areas, and that's pretty much because that's what the feds want. They want to decrease demand for products, so to lower inflation. And I'm noticing it here. A lot of people are holding off on buying homes, which, you know, for home inspection is not the best thing in the world, but now with everything going on, and people, you know, don't have the confidence of buying the house, especially at these elevated prices, and now the rates hit pretty much 8%, and I think that's somebody with good credit. You know, people are like, yeah, we're going to hold off. So if you start seeing, like, if you go to your Zillow and your realtor.com and you start seeing all these price adjustments, and you see everybody reducing rates, and you see more and more houses in inventory, you know, that's a sign that the economy could be in trouble, you know, because one of the first things that goes, the most expensive purchase is people's homes. Then it's cars, you know, and it just seems like both those things are in trouble, houses and vehicles. Tell me what you guys think. But at least Florida was always a hot market, and some areas maybe are a hot market still, but not many. But I see it cooling more and more. Maybe it's a seasonal adjustment, not 100% sure, but so watch your housing market. If the housing market is slowing down and you're driving down a street and now you see one for sale sign after another for sale sign, it could be because people are in trouble and they just can't afford it anymore and they're selling it. So look for those signs, okay? The housing market. All right, let's go on to the next one. All right, number 7, slowing down of manufacturing and business investments. So, I mean, companies, especially big companies, they do their research. And if you notice that, and if the numbers come out that they're not investing as much, you know, into their business for new products, you know, or expanding their product lines, they might know something, because they're not going to invest billions of dollars to some companies, or a lot of companies millions of dollars, but they're not going to invest all that money unless they do their research. And if they see something that spooks them, they might be like, yeah, we're not going to invest right now. And that could be an indication of the economy getting in trouble. So look at that. I'm sure there's some numbers out there that says how much businesses are investing right now. But if you see businesses cutting back, it definitely could be an indication of future economic situation. All right, let's go on to number 8. All right, number 8's a big one for me. Well, I think it's one of the biggest ones. It's basically consumer debt. So basically, people had a lot of savings, now their savings are gone, and now everybody's pretty much using credit cards. And the debt on credit cards hasn't been this high for years. I'm talking about super high. I think we're breaking records right now. I'm not quite sure. I didn't look that stat up. But everybody's has credit card debts. And a lot of people are stealing from Peter to pay Paul, the old saying, you know, just to make the minimum payments. And you know, if you're making the minimum payments, you're never going to pay off that credit card. And something else came out that the average American, a lot of people can't make a simple $400 repair. So say something breaks in their car, or at their house, if they need to spend 400 bucks in an emergency, they don't have it. They got to put it on a credit card. And now credit card companies are seeing that, and a lot of people that have $15,000 or $20,000 credit line but owe $10,000 on a credit card, a lot of them are saying, hey, you know what? We're going to reduce your credit line to $10,000 because, you know, you're making the minimum payments and we don't know if you could afford if the balance reaches $20,000. So consumer credit is a big thing. So if you see consumer credit increase, that's a sign that we're in trouble, because it's always a sign, basically. So let's go on to the next one. Here's one that nobody talks about: freight transportation index. So basically, if that number goes down, there's less products being transported. And if there's less products being transported, that means that, you know, companies aren't ordering as much because they're worried about things. So take a look at the consumer index. It's a freight transport index, the TSI index. And if that's declining, then what you guys need to do is put that as an indicator that the economy could be getting into trouble. So a lot of people, I never heard about this one until I read this article. Then I researched it a little bit, and it's true. It's an indication. There's a graph that goes back many, many years, and it seems to follow the recession trends. All right, let's go on to the last one. Money velocity. How much cash is around? How easy is it to get credit? How much are people, you know, have to spend? You know, if you see money velocity go down, there's just not enough capital around for people to accomplish things, and banks aren't lending and they're holding on to their cash, and people are holding on to their cash, that's an indication the economy could be getting into trouble. I mean, there's so many signs, and it doesn't mean that one area, you know, in general we're talking about, but it doesn't mean that one area could be booming and another area not doing too good. So basically, look at your area, see how it's doing. But on the national trends, you know, my big thing is consumer debt and consumer confidence. And consumer confidence is dropping like a rock, and consumer debt is increasing. So what do you guys think? I think we're in for something. This is my personal opinion. Like I said at the beginning, I'm not an economist, I'm not a financial planner, but I think something big is going to happen. May not happen the rest of this year, but I think by the middle of 2024, we're going to see something. I'd like to see what your opinions are too. So anyways, that's today's video. I greatly appreciate you guys watching. As always, do me a favor, consider subscribing. It really helps out the channel. Takes a second. And the next video will be either here or here. I never get that one right, but check it out. All right, I'll speak to you guys soon. Bye.